What kind of instruments do we use for money management and trading? Well, you've probably heard of mutual funds, index funds, ETFs, and of course you already know individual stocks and bonds. You can buy an individual stock, or you can have a portfolio manager or team of portfolio managers managing a group of stocks in an actively managed mutual fund. The way that that works is they're running fundamental analysis on various stock ideas, determining what's in, what's out, and how long they're going to hold them. Mutual funds do not trade intraday, so you don't go out to the stock market and trade a mutual fund at, say, noon. So it does not have instant liquidity. The advantage of an actively managed mutual fund is that you can choose a highly skilled manager in an area where there might be some inefficiency. And so we may employ some actively managed mutual funds in our process. An index fund is getting broad exposure to all the stocks in an index. So take something like the S&P 500, which is the 500 largest US-based companies. An index fund would invest in all of those companies, and they have different methods for doing that. Some of them are equal weighted, some of them are cap weighted. But the point is you're just getting general exposure to all of the companies that are in that index. They also trade at the end of each day, but the expense ratios or the fees on the funds are generally lower because there's not active management or fundamental analysis involved. An ETF takes it a step further. So an ETF, or an exchange traded fund, gets exposure to a given area. So it gets exposure to an index or a theme or a sector, and it trades intraday because its movement, its price movement, is based upon the price movements of what it reflects as underlying investments. So an ETF or an exchange traded fund does trade intraday, so it does offer instant liquidity. If you go out there at noon or 1 o'clock and you want to trade something, you can hit the button on it and trade out. So most commonly, in terms of our money management and how we manage investment portfolios in our risk models, we generally use ETFs. We will sometimes use index funds, and we will also use actively managed mutual funds in specific areas where we believe that there are inefficiencies to exploit, and we'll use highly skilled, well-vetted managers in those areas. From time to time, we will also buy individual stocks for which we follow institutional research on the fundamental side. So we may put some individual stocks into those risk models. We generally do not buy individual bonds, but generally we will use an active mutual fund manager in the bond space because we believe that fixed income is an area where you want a highly skilled manager working for you. So just to reiterate, stocks, bonds, active mutual funds, index funds, and ETFs. We will generally use a combination of all of the above minus the individual bonds when it comes to managing our risk models that are customized within Altruist, our trading partner and custodian.